Welcome back once again. So here we are at chapter 4. So again, everything that we've learned from chapters 1 through 3 are going to be, it's going to make more sense when we look into the accounting cycle, because it's going to involve the financial statements once again, which was chapter 1. Right, we're going to be looking at how to create reports that are involving the debits and credits, so that's chapter number 2. And then lastly, we're going to be also be taking at how a journal affects these transactions. So again, this is going to be the accounting cycle. So let's go ahead and talk about what the accounting cycle is. In this case, the accounting cycle is a collective process once again, but it's also it's a method of rules that helps us ensure the accuracy of our accounting. Okay, so this is normally these steps of these accounting cycles. You have to perform all 10 of them, and I'll talk about what they are in a second. All right, and again, once again, it's going to take the financial statements and it's going to make a collective process of recording and processing the accounting events of a business. So once again, we're going to be also, again, this is in tying with the accounting definition, right? But in this case, it's a sequence, or it's a series of steps that you need to take in order to ensure that you are doing the accounting correctly. So what are the measurements that we're going to be needing, right? We'll go through every single step in a second. But first off, the most important thing that we need to understand is, what is the purpose of creating these financial statements, right? We talked about why we create the financial statements. So we create them for two types of users: our internal users and our external users. Now, what's so important about these financial statements? Well, first off, every time we create a financial statement, it's got to be reliable, right? First things first is, when you do business, right? If we have source document, that just proves that a transaction has occurred. So that makes our information reliable. We can trust it because we have proof of those documentations to prove that these transactions actually really did happen. All right. Another thing is going to be relevant. So a good way to stay relevant is that, of course, if you've been doing bookkeeping for a while now, right? Every business starts out somewhere. So if in order to produce relevant financial statements, one way is to keep the time period pretty current, right? You definitely don't want to put something in the books that was 10 years ago versus now and compare 10 years ago to now. No, it's not going to really work, because there's so many factors that change, such as the value of a dollar, right? You can't expect the dollar to hold its value 10 years ago, right? It's drastically changed for many, 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 many reasons. So you definitely want to make your statements relevant by, keeping it within its current time period. Like, if you're doing 1 month, make sure it's only that 1 month, all right? And then we're going to talk about consistent. Yes, so consistent. So when we dive into actually looking at every method that we look into for the rest of the class, so we'll be taking a look at the different methods when we keep track of our inventory. We're going to be looking at different methods that you use to cost out inventory. And then you're going to be looking at methods to write off bad debt, etc., etc. There's a bunch of methods. And we're going to even talk about, today we're going to talk about the accrual versus the cash method, right? So the purpose of being consistent is so then we have a, clear standpoint of measuring either profitability, right? If you decide to that 1 month you decide to do one method, and the other month you decided to try out another method, then can you really compare them. If you're using two different methods, then it's really going to make your financial statements a little harder to understand, but it's not going to be consistent, and you're not going to be able to have some kind of way to determine whether this is a good method to measure whatever it is that you're measuring, right? Profitability, right? So you definitely want to be consistent. If you choose a method, stick with it until you feel that it's not working for you, or anything vice versa. Now, here's a little tangent side note here. The IRS will allow you to make changes to your methods. However, you can only change it about maybe once or twice, okay, throughout your entire business. So, for example, if you decided you wanted to try out one of the costing methods to keep track of your inventory, and you feel that it's not working for you, yes, you can go ahead and change it. However, you have to let the IRS know, because again, they're the ones that are going to be overseeing your financial statements, and they want to make sure that whatever calculations you've done on your end is going to be the same on their end, right? They need to make sure that they calculate the proper taxes that needs to be taken out. And then lastly is going to be comparable. Now, comparable is pretty straightforward, right? You want to make sure that you're able to compare yourself to another company that's either in the same industry or has the same type of business activity. Okay, so for example, right, if you're going to be a coffee shop owner, right, you definitely kind of want to make yourself comparable to, Starbucks, Dietrich's Coffee, Dutch Brothers, right? Even though they're a bigger type of company, but just how they conduct their business, right? The only reason why we want it to be comparable is because if we do release these out to our external users, right? If investors are looking at comparing two different coffee shops, right? They look at your report and they look at this report, and they see that that Starbucks does an excellent work and producing easy to read and clear, clear cut financial statements, and yours is a little messy, disorganized, things don't translate very well, then you can definitely see that they're most likely going to invest in Starbucks, because they just produce their financial statements a lot cleaner and a lot better. Now, another thing too is you could also use your financial statements to compare yourselves to other ones. So when we talk about industry practices, right? You want to kind of see what they're doing. What makes them so successful, right? And you would try to follow in their lines to make yourselves comparable. Be part of the competition, all right? Any questions in regards to that? Okay? So again, if you are going to look at the characteristics of financial statements, you just know them as the 3 R's and the 3 C's. Reliable, relevant, comparable, and consistent. Okay.
You mean 2 R's and 2 C's, right?
Yeah. Yes, 2 R's, 2 C's. What did I say?
3.
Oh, my bad. Yes, 2 R's and 2 C's. No, you're right. Thank you. 2 R's and 2 C's. Okay. Total and 4. Right. These are the 4 characteristics that once again, it just makes it a lot easier if you're able to make sure that these characteristics are on point. Okay. Now, I can introduce you to the accounting cycle. Now, you can always treat this accounting cycle as your checklist of what you need to do when you are trying to look at a company, and when you start producing your financial statements, these are the necessary steps that you have to do. So, step number 1, right? We got to collect our source documents, which again, I'll break down each and every single one, and I'll even throw in an example. Well, first things first, we got to collect our source documents, right? Number 2, we're going to analyze the data. And number 3, we're going to journalize it in the general journal. So these 3 steps, the very initial 3 steps, are also part of the transaction analysis, right? However, the transaction analysis, right, it helps you determine if that transaction is even worth to record, right? It helps you determine how to journalize it and how to differentiate the difference between a personal and a business transaction. Okay, so again, the applied knowledge that you learn in the transaction analysis are going to be within those 3 steps of the accounting cycle. Okay, once we do that, then when we talked about the general ledger, it you literally have to post it to the general ledger afterwards. So once again, when we talked about the general journal, right, it's just a book full of daily transactions. Now, the best way to keep your books in check or to verify that you did your accounts correctly is to always have some kind of running balance, which is in the general ledger. So again, we talked about the checking or the cash account, right? That is all going to be one of your most primary or priority that you should have a running balance too. Because every time you write a check or every time you spend cash or whether you receive cash, you definitely want to make sure that you have enough money in order to write those checks. But also you want to make those deposits of checks so you always know how much money you have in your bank account at all times. So that's why step number 4 is to complete the general ledger. So updating all your account information with their respective balances, right? And then step 5. Step 5, I'm going to introduce you to the trial balance, which, again, is going to test you for one thing and one thing only. Does your total debits match your total credits? Okay? And then we're going to dive into number 6, which is going to be adjusting entries. Okay? Then step 7 is going to be the post-adjusted trial balance. So once again, you're going to, after you've entered in your adjustments, you want to make sure that that your debits match your credits. And then step 8 is to go ahead and proceed with creating the financial statements. Okay? Then step 9 is you're going to actually close out your temporary accounts, which are your revenues and your expenses. So we call that as closing the books. Because now, once we close the books, we can start open a new book and start keeping track of all the sales and all the expenses that occur the next open period, okay? And then lastly, to ensure that you've properly closed out all of your accounts is to run the last post-closing trial balance. Okay? So let's go ahead and take a scenario and take a look at how we take a look at the accounting cycle. So here, step number 1, of course, is to collect your source documents. So we talked about this briefly in the transaction analysis. Any proof of a transaction can be either a receipt, an invoice, a checkbook, a bank statement, and even contracts, right? Anything where you can see proof that money has been either transferred somewhere, spent, moved somewhere, okay, as long as it's like some kind of form of legitimate paper. Now, most cases, your type of source document would be more or less either your sales receipts or even when you go out and buy stuff, those kind of receipts, invoices, and typically bills that you get in the mail from the vendors. Okay? And again, collecting any piece of information will help you determine, well, was this for the business or was it for was a personal charge? Okay? So again, you need something that has proof that a transaction has occurred. Then we're going to answer the 4 questions, right? when you're trying to analyze the source document. So we're going to analyze it and we're going to sort it, the data. So in step 2, as you can see, in a or on a receipt, right, it tells me it should answer these questions. When did it happen? What did it happen? And how did it happen? All right? There's no need for why, right? Because it's kind of self-explanatory. So first off, what has happened here? You made a purchase of office supplies. Okay? How can I tell that? Well, I went to an office supply store and I purchased office supplies. Pretty straightforward. And then now it's going to be when. Every receipt, every invoice, every bill is going to have a timestamp on it. It's going to have the date written all over it. Okay? That's your proof of when the transaction has happened. And again, the how. The how can be determined either how much your total amount is and how did you pay for it. So in this case, my how is, well, I paid $61.09 and I paid it with cash. Okay? So now that I determined those two factors, I paid with cash. So now I'm going to sort my data. I need to have a cash account and I need an office supply account because I purchased black pens, I purchased copy paper, and I purchased ink for my printer. Okay? So pretty straightforward. It's going to list all the items that you have necessary of what you purchased. Okay? Then we can go ahead and move to step 3. After we do the transaction analysis once again, right, we determine which accounts are going to be debited, which accounts are going to be credited. Then we can go ahead and go over here and we can journalize it. So that's step number 3 is the same thing as step number 7 in the transaction analysis. Okay, here we already know what book we're going to be placing it. It's the general journal. So here we have the scenario that on June 6th we purchased office supplies with cash costing a total of $61.09. Okay, so here we are. We posted the journal and there it is. Okay. Now step number 4 is entering the information in your general ledger. So again, a general ledger is a list of every single account that exists in your books or in your company, right? Everything that's on the chart of accounts is going to be in the ledger, and every single account is going to have some kind of respective account balance. So for example, here I have my cash balance right here. It tells me that this is what I started with, my cash on hand. I had $2,000 cash on hand. So that's what I started with. And then I made the purchase of office supplies. So therefore, I spent cash, right? I have cash in my hands and I spent $61.09, which it has updated my account to say that I should only have now $1,938.91 left. Okay? And then here, I also update my office supplies account. I've updated it because I acquired an asset, right? I acquired office supplies, so therefore I increased my office supplies, and now I have an account balance of $61.09. Okay. Once you've done the general ledger, right, you're going to continue doing that until you reach at the end of our particular end of your transaction. All right, here he is. Hello. Okay. So once we've reached our end of our transactions, or this is like the time where we want to stop recording. Usually we'll talk about the accounting period in a couple minutes, but I'm done with my transaction. So once I finish doing all of that, that's where step 5 is going to come into play. So as you can see, my trial balance here is for the end of June. Okay. So here we have a total balance in my cash account for $2,248. Now, all of these numbers here are going to the main key factor is once you complete your general ledger, they all have account balances, correct? What you're going to do is after you completed that, this is where the trial balance is going to take all those figures that you've computed in the general ledger and transfer the information here. So what the trial balance does is it's another list of every single account that exists, but in this time I'm actually going to compare all my debits balances, so all my normal debit balances, and I'm going to compare them to all of my credit balances. And at the end of the day, this must hold true. Your debits must equal all of your credits. Okay? So we see that when we journalize, and we see that here when we do a trial balance. Okay? But here in our journal, we're just only doing day-to-day transactions. Here, we're comparing every single account balance that we've accumulated so far. So in this case, here's everything that's that I used so far in the business, and I'm comparing. Do my debits match my credits? In this case, they all do. All right? So it should be at the end of the month, given period, whatever it is that you claim. All right? Okay. And most cases when you do a trial balance, it's unnecessary for you to enter in anything that has a zero account balance, just because, does that really affect your debits and credits if it's a zero balance? Not really. No, because it's zero. So in this case, it's unnecessary. So that's why in my list here, it's very short. Okay. So now, once I completed my trial balance and I do get my debits matching my total credits, that's where I can go ahead and enter in my adjusted trial balance. I'm sorry, my adjustments. Okay, so adjustments are things that you need to adjust when you are, at the end of your accounting cycle, when you're trying to wrap up things. So in this case, what entails as part of the adjustment process, right? So adjustment entry, right? We will get to look at all of these in class. We'll take a look at the periodic inventory, right? In the next chapter, chapter 5. We're going to be taking a look at depreciation, okay? Which is chapter 11. We're going to be looking at supplies expense. Again, supplies expense is going to be something that we do during the class project. And then cost of materials, or also known as cost of goods sold, you will also learn in chapter 5 as well. But we'll also take a look at it in a more grander scale in the class project. And then lastly, bad debt expense, which we will learn in chapter 10. So all of these, again, are going to be adjustments. So when we talk about adjustments, we're talking about if I acquired an asset, right? And I need to adjust it because I either spent it, got rid of it, or I used it, right? We are going to write them off as an expense. So in this case, I purchased my office supplies for $61.05, right? But in this case, I counted my supply office storage, and I noticed that I only have a few things left. So, but everything else has been used, okay? And there's ways that you can measure it, right? If you keep track of all the pens, obviously, or if you keep track of all the cartons of paper or the ink cartridges, right? So once you've determined how much you actually used, that's where you're going to expense it. So in this case, I have an office supplies account and I have an office supplies expense. So in this case, I used $50 worth of all those supplies. So I probably got rid of a lot of my pens. I probably used a lot of the copy paper, and of course the ink. That's kind of, if it runs out of ink, then you would expense it then. So in this case, I found my total of $50 that I used throughout the company for its operations. And of course, I'm going to take it directly out of my office supplies because my office supplies is no longer $61, right? I'm going to decrease the account, right? Because I'm crediting it now, so that it reflects that I should have, 20 pens left and a stack of paper left. Okay? So this is an example right here of how we use our materials and we end up expensing it. Okay? Other things too, depreciation expense, right? If we buy an equipment, it doesn't hold its value at the end of the year, right? Because you used it. So in order for us to reflect that we used it, we're going to depreciate it. Okay? And again, this is going to be in chapter 11. Okay? So once we complete our adjustment entries in here, right? We journalized it. We have to make our adjustments, post it back into our ledger. Then we need to complete an adjusted trial balance. So this is after the adjustments. Okay? Once we can confirm that, once again, our debits and our credits match, right, with the adjustments. So as you can see here, I've added a couple accounts. I added the office supplies expense, and I've added the depreciation in here. And notice this, I added them in here. I've also taken it away from this specific account. Okay, so now that I've done that and my debits and my credits match, therefore I can go ahead and proceed with my financial statements. So again, because we completed the trial balance, you have every single account balance from all of the accounts that exist in your books. So you're going to use the information in your trial balance and you're going to plug them in each financial statement. So here I had a total sales of the 1860, which in here I've also have a sales of 1860. So I pulled the information from my adjusted trial balance and I just computed them all in here and arranged them in a way that I can use that information. So in this case, my first statement, this has to go in a particular order. I'm going to go ahead and use my create my income statement first. This is going to determine whether my company made a profit or a loss. In this case, I have a positive number, right? I took all of my sales and I counted them against all my operating expenses. And here I determined that I actually gained money out of it. Okay? Once you do that, then you can go ahead and proceed to your statement of owner's equity, right? Because the initial thought here is that when you're dealing with the adjusting the statement of equity, right, you have a couple factors, right? If you have a profit, you can either reinvest it back into your company and so on and so forth, right? If you choose to reinvest into your company instead of profit this $300, then you're going to increase the value of your company, right? And the other contributing factors, once again, is our capital contributions. But here I took owner's withdrawal, so that decreased the value of my company because I took money away from the company. Okay. So in this case, I've reinvested in my company for the $300, but I did not take anything away from my company. So I am good here. So that means my statement of equity from the beginning, which I started off with $2,000, now it's increased to $2,309 because I reinvested into my company. All right. Once you've completed the statement of equity, then you could go ahead and complete your balance sheet. All right. Once again, the balance sheet is going to list out all of your assets and it's going to compare it or plug it into the equation. Is it equal to all of your liabilities plus your equity? And in this case, I took the equity that I solved from my previous statement. So do you see how you have to do one statement at a time, and you have to do it in this order. All right. So here, once I've computed that, at least I know one portion of the equation. I have my equity. All I need to do is solve is for my liabilities and my assets. So in this case, I have no liabilities. All I have are my assets, which I tallied them up, and they equal to $2,309.17. And what do you know? That's exactly what my equity is, because I have no liabilities plus my equity, they match, right? My accounting equation holds true. All right. Once I've done that, that's where this statement of cash flows is going to be created. Now, the statement of cash flows is going to reflect all the information from the trial balance, because it's literally going to take all of your assets and all of your liabilities, and it's going to place it right directly into this statement of cash flows. Now, again, we talked about briefly that you're going to have to start out with your net income, because if that's going to be a contributing factor, whether you made a profit, cash sales, or credit sales, right? Whether you received cash for it or not. Then it's broken down to operating, which is typically your current and other assets, as well as your current liabilities, right? And then you're also going to have investing activities, which is usually your fixed assets. And then financing activities are going to be your long-term liabilities. Okay? And once you've done that and you compare everything, you should match the beginning of your bank account, right, as what you started in June 1st. And then it should equal to the amount of cash that is remaining as of the end of June. So in this case, I should have 2248.91, and if I look at my balance sheet, that is exactly the same exact amount of cash I have available. Okay, so as you can see, every single financial statement is going to build upon each other. You need to complete one in order to complete the next one, because they are components of each one. Okay. Once you complete the financial statements, then step number 9 is to close out all your temporary accounts. So we talked about this as well. What are your temporary accounts? It's going to be every single revenue and every single expense account. And we have a place to place them, which here it's the income summary. Now, if you're looking at corporate terms, it's the same thing as your retained earnings. Okay, so here, but in this case, because we are focusing on a sole proprietor or a small business itself, we're going to zero out every single account. So all of our sales account is going to be zeroed out and placed it into income summary. Okay, all of our expenses are also going to be zeroed out into the income summary. And then once you get that number, the income summary is going to zero out into your equity. And notice this, your income summary should match the same number that you got in your profit and loss. Okay, so there's a lot of point of references that you can kind of see. So when we do everything and we piece our financial statements together, everything starts to fall into place, and everything you're going to notice is they start to match up. And as they match up 100%, you completed your entire process and did your accounting correctly. So here, that's my profit, my $300.17, and I'm going to, again, zero that out into my equity. Okay? And then once again, I'm going to run my post-closing trial balance one more time to ensure that all of my assets, right, and after I close out my my temporary accounts, my equity should equal to 2309.17. Okay? Any questions? in all of these steps. Okay?
I have one.
Yes.
So I'm just confused. So on the last chart, step 9. So there's not a minus or plus, and that's only like there's no way to distinguish like, or I would just know because it says expense is a minus. Anything that says expense is a minus, not a plus.
Okay. So this will make more sense because we don't use minus and plus in accounting. We use debits and credits. If you remember when I was explaining how a debit and credit works is you never refer them as a minus or plus. It depends on what account you're looking for, and it depends on which flow. What are you going to do if a normal balance for a sales is a credit, right? In order to zero out that account, we're going to debit it. Okay? Same thing with my expenses, right? If it's a normal balance is supposed to be a debit, in order to zero it out, you need to credit the account. Okay? So there's no, plus or minus here. Okay? It's debits and credits. So again,
Yes, yeah, it's just it's going to take a while.
yeah, don't. Again, we are not going to dive into this until the very end of the class. So I'm just telling you how the accounting cycle works, but we will complete the whole entire 10 steps of the accounting cycle by the end of the 15 weeks. Okay?
Thank you.
All right. So again, out of the 10 steps for right now, we're only going to be focusing on the first 3. Okay. For the next 8 to 10 weeks, we are only focusing on steps 1 through 3, practicing how to journalize, how to recognize the transaction, and how we use the debit and credit system. Okay, and then once we dive into our fictitious business, that is exactly where we're going to utilize and learn steps 4 all the way to steps 10. Okay, so any questions in regards to the accounting cycle? For now, I only need you to recognize what they are, but not how yet, because we're only going to be learning the first 3.
I'm good.
Okay. All right. So now we can finally talk about the accounting period. So the accounting period is kind of straightforward, kind of not. The definition of it is when you choose to schedule to complete the accounting cycle. All right? So as we've mentioned before, how many steps are there to the accounting cycle? 10. Now, just me explaining exactly what to do, how long do you think it's going to take you to complete all 10 steps?
A year.
It can take a year, and that's why we have these options here. Example, you can do it every day, you could do it every week, you could do it every month, you could do it every half of a year, or every quarterly, or you could do it every year. Okay? Now, it really depends on how many transactions you're going to be dealing with in each company, right? If you're a small company and you only do maybe a couple transactions here and there, then it's possible to do it every day. Okay? But if you're like a major corporation like Walmart or Target who's processing anywhere from 1 billion transactions a day, doing it daily is probably not something you want to look forward to. All right? And that's exactly why those major corporations, they throw in a lot of money to the big guys, right? The big 4 companies, the accounting firms, to do the work for them. Okay? And that's also one of the reasons why anybody that's a licensed CPA, is going to be paid a lot of money because they're going to be spending hours. And when I say hours, anywhere from 80 hours a week just to complete all the transactions and financial statements for this company. Okay? So with that being said, okay? So realistically, by looking at all of those 10 steps, it just really depends on how comfortably you feel it is necessary to complete it. Right? So as a sole proprietor, you do have the choice to claim which one works best for your company. Now, most often cases, I'll tell you this, most cases, the best way to measure your company's profitability or if they're doing well or not is maybe do a monthly do the financials every month, because if you do a monthly projection, you could see a nice slow growth, or maybe you might can see a slow decrease, right? Or you could actually do it quarterly. Most corporations, they try to do it quarterly and then they sum it all up and do an annual one. Okay? Now again, all of those 10 steps to the accounting cycle, they do take time, and we will take a look at it when we dive into the fictitious business, and we're going to test how long it's going to take us to complete all 10 of the steps. And I can tell you this, it will not take one day. It could take a whole week. Okay? All 4 days. So with that being said, that is what the accounting cycle is. It's just when you schedule to complete the accounting cycle. An example could be a daily, weekly, monthly, depending on what your company is, right? Now, the second portion here is going to be talking about how often you file your taxes. So, calendar year versus fiscal year, right? The main idea is, when is it convenient or when is it easier for you to file your taxes? So again, you have to file taxes every year. So how are you going to measure your profitability, or measure all and do all of that, all the financial statements, computing all of that, and also at the same time reporting all your taxes? What makes it easier for you? Okay, so a calendar year is pretty straightforward. It's from January 1st all the way to December 31st, right? It's 12 consecutive months, correct? Whereas a fiscal year, it's any 12 consecutive months starting on the first of the first month and ending on the last day of the 12th month. All right? So, most cases, either or. A lot of companies, right, if you are a beginner kind of company, you should just stick with calendar. It's just going to make it so much easier for you to, properly file your taxes and have the time to manage all your, your transactions, but also manage all of your reports and stuff like that. Put together your financial statements. So again, yes, if it's easier, it's also easier to remember. First day of the first month, January 1st, and then you just end at December 31st. Okay? Whereas fiscal year, right, it's kind of more along the lines of what the type of business is. So, for example, right, a bathing suit company, right? When is their most sales happen?
What type of company?
During summer. During summer.
A bathing suit
Oh,
company. A bathing suit company.
Oh,
During the summer.
probably spring and summer, yeah.
Yeah.
Would it be spring before summer?
It could be both, spring and summer. So then, therefore, their busiest time of year is going to be anywhere from March all the way to August, right? Because, depending on those kind of things, right? So that's going to be the busiest time of the month. So therefore, realistically, they're not going to file their taxes until maybe sometime in the fall or the winter. Okay, they don't have to be necessarily on the calendar year. They could there for theirs. It could be from March all the way to February, right? Or I'll give you another example. How about a Christmas tree company? When is their profits most high, I guess?
During the winter, the end of the month,
During
end of the year.
exactly. So if they're more busier in the end of the year, then they are most likely to have the time to process things in the summer, right? So their kind of fiscal year could be from July 1st all the way to June 30th because they're not busy during the summer. They can work together and compile their information a lot easier on that type of schedule. Okay, because they're not busy during the summer, they're more busier during the winter. Okay, now again, most government agencies, they fall under the fiscal year. Most cases, it's always July 1st is going to be the new start of the budgeting year, and then so on and so forth, because everything, especially during the winter, right? What happens during the winter? Every November, what happens?
Oh, elections.
We got elections. We got new laws putting down, new tax laws, new, adjustments to any of the state and local agencies. Every year you have a new budget, right? So you can say that in the winter between November, December, January, it's going to be super hectic for the federal government, and they're most likely not going to be able to process a lot of this stuff. Okay, because they're more worried about, oh my gosh, what's the annual budget this year? How much money am I going to get this year? When is it going to start? January. What about taxes? Taxes are always going to be changing every year. So all of that, you can say that the federal, they're more busy during the summer, they're more busy during the winter. I'm so sorry. They're more, yeah, because of those things, right? We got elections, we got new tax laws, whatever it is, right? They're more occupied during the winter, so their fiscal, or they're more less likely to be less busy during the summer. Okay, so that's an example of both the calendar and a fiscal year. Again, both of them, again, it says year, so there has to be 12 consecutive months, and it depends on what it is. So for the calendar year, once again, January to December. In fiscal year, it could be any day of the first month of the first day of the first month, all the way to the last day of the 12th month. Okay, any questions there? Okay, now we are going to be diving into the generally accepted accounting principles. So here is where I've mentioned here and there about the difference between the rules that are set for accounting. So first off, what is generally accepted accounting principles? It's a set of rules and guidelines that are governed by FASB to help ensure the accuracy of our accounting, but to also ensure that there is no potential threat or fraud that could happen. Okay, and how it is determined based on its principles, its assumptions, and any modifying conventions. Okay, and who is the FASB? FASB is going to be the Federal Accounting Standards Board. Okay, FASB for short. Now, they are the ones that created GAAP. Now, GAAP is only used in the United States, so you can also hear as US GAAP, but I mean, if you already know, we're in the United States, so we just say GAAP. But anyways, yes, all these rules and standards apply only in the US. Okay? Now let's talk about the international. So we talked briefly about when we do international trade, we need to follow the international guidelines on how they do their separate accounting. So for here, we have the International Accounting Standards Board, ISB, right? And ISB are the ones that are responsible for creating the IFRS, the International Financial IFR Reporting Standards. Yes, IFRS. Okay, and those are governed between the European states. I'm sorry, European countries and other countries around that, such as those minor countries like Middle East and some parts of Asia. Okay, however, we are only focusing on the United States GAAP because we're here in America. You don't need to know anything about the international financial reporting standards, right? Because we don't need to know what they are. We live in the United States. We're only bounded to the U.S. GAAP. But like I mentioned earlier, if you are interested in doing international trade, then definitely have some kind of course into the international rules out there. But it depends on what country you do business in too. So don't just assume that we're just going to go straight to the IFRS. It depends on what country that you want to do business in, because maybe they don't use the IFRS. They might use some other different type of standards boards. So I know for sure the Philippines, they use a complete separate one. But again, we only introduced to the international, the ISB and the FASB, just because they're just close. They're closely related, and in context, we both use English. Okay. Again, the ISB is going to be established in London once again, and they oversee pretty much all the European states. Right. All right. Any questions there? Okay, so now we can finally introduce to you the assumption. So there are a total of 12 things that you are going to be taking a look at, and they're all separated by 3 categories: your basic assumptions and your basic principles and your conventions. So here are the first 4, which is your assumptions. So the first one we're going to take a look at is your business and or economic assumption. This one's pretty straightforward. It just tells you that when you are recording your transactions, you need to keep your business and your personal transactions separate. All right? And a perfect example of that is going to be having a separate business bank account versus your personal bank account. Okay, now as a sole proprietor, when you do open up your own business bank account, your name's on the credit card. That's absolutely fine, because again, you and the business are one. However, how you use the business credit card is going to determine whether you use it for a personal or whether you use it as a a business transaction. Yes, you can use your business credit card to write off a few personal assets or transactions. However, that's not very good when you're doing business, because you shouldn't take advantage of that, because you can be audited for that. So just make sure that you're careful and think that you can write off all your personal assets because you put it towards the business. You want to be very careful with that. But again, that is a good example, is to have a separate bank account and have a separate credit card for that to separate your business with your personal transactions. Okay, pretty straightforward. Any questions for that one? Okay, so then we're going to talk about the second one here. Going concern. Going concern, all right, assumes that a company, no matter if there is a foreseen foreclosure, the company is going to continue doing business as usual, and conduct its core operating business no matter what. So, a good example here is Sears, right? We know that Sears has some troubles here and there. I believe all Sears around, I think the United States has it's officially filed bankruptcy and it closed its doors. But while it was filing for bankruptcy, right, it still continued, you know, conducting its sales until they had the official date of closing their actual doors. So in this case, you know, they were trying to get rid of their inventory, and they still conducted their sales as usual. Although they discounted everything, they still they still went on through with their operations to try to get everything out of the store before the closing date. So that is one assumption here, is that you're going to continue doing business as usual until you officially close out your business. All right? Any questions here? Okay. No?
Nope.
Okay, so the next one is actually going to be a big one. It's also a very common sense one. So we're going to be talking about monetary assumption. Now, monetary assumption is going to be split into three criterias, or, you know, I guess three sub topics, I guess. So, number one is that you need to have some kind of uniform type of currency. All right? Of course, in the United States, right? We live off of the United States dollar bill, right? Nothing is going to compare. Nowadays, we have what do you call it, cryptocurrency, that can be placed in as some kind of form of currency that we use. Right now it's not widely recognized, but you can currently use it, and it's also in terms of dollars, right? What if you go look at what is it, Bitcoin? It's worth $36,000, right? We can convert it into cash. So at the end of the day, we are still using a form of some uniform type of currency in our system. And in this case, we're always going to refer everything in the US dollars. Okay? If you are using foreign currency, you have to convert it into US dollars. Okay? And then we are going to talk about how the monetary measurement works. So, monetary measurement pretty much tells you that all transactions that you record has to be in terms of value. Okay? So, in this example, we have employees, right? When we record the number of employees in our company, right? We don't use how many. We don't use quantity to determine this business transaction. We actually have to calculate the total cost it takes in order to have an employee. So if I had it, for example, 20 employees, right? And I can't write 20 employees in my journal. It has to be that I'm going to spend $100,000 for having those 20 employees, right? Whether they're salary, whether they're wage based, I'm listing them as a total grand cost. It's going to cost me $100,000 to have 20 employees. All right, so that's the monetary measurement portion of that one. And then lastly is going to be stable currency, which is taking a unit of currency that is stable, and basically what you use this is in order, since the United States dollar, right, it's backed up by the gold standard. How we use this and compare it is that we're going to take this dollar, and because it doesn't change its value too much over time, right? Well, we talk about inflation and recessions. The dollar doesn't change that much, right? It's not very drastic. It's drastic from if you're comparing 20 years from now or 20 years ago and now. That's a huge drastic change. But for now, because the way that the United States dollar bill is backed up by the gold standard, it's going to be.
Correct on that? I thought we didn't do that anymore. I thought that ended like back in 1970 something.
I it's still backed up by the gold standard, is it not?
No, it's not. It's backed up, but just our government. We're gonna kick your ass. So yeah, no. We don't do the gold standard.
Okay.
Sorry. Yeah.
I'm gonna fact check that, but okay.
Yes.
Okay, whatever the United States dollar bill is backed up on, but it's still considered a stable form of currency. That's what I was trying to get at. Whether it's backed up by the gold standard or
No, we
whether,
don't. Yeah,
yeah.
we don't do. Yeah, no, because if you have any dollar that's worth like 1950 something, that's backed up by silver. You can
Oh,
trade that in.
okay.
I don't know how that works, but I know we don't the gold standard. That's why we have inflation, um, just because we're not backed up by the gold standard.
Okay. Whatever it is, I think, sooner or later it's going to be backed up by the Bitcoin now. I don't know. It's going to be backed up by some kind of cryptocurrency because that's what they're trying to fight for right now. So whatever it's being backed up on, whether it's silver, gold, or cryptocurrency, it's still considered a stable form of currency, right? Can you tell me if I talk about a dollar today, what is it going to be tomorrow?
A dollar.
It's still going to be a dollar. What about in the next 10 days? 10 months?
Now, are we
1 year
talking
from
about
now?
international or just local?
No, what do you mean international? We're not talking about international. This is all US GAAP.
Oh no, then in U.S. it's going to be a dollar. But if if it's international, a dollar varies every day.
Absolutely, yes. And there is a website that you can do that, but that's only if you're doing, again, foreign exchange or if you're going to do international trade. Because, again, especially looking at how the difference between a dollar is against a pound, it's crazy.
It's a lot
Yes,
less.
yes. There is a website that you can take a look at that. I don't know what it's called, but it gives you a list of how the dollar changes every day. I think it's based on every hour too. You can make it that specific if you want. Every hour, every day, at any given time. All right. But anyways, going back to this, we're just understanding that the U.S. dollar is still some kind of form of stable currency, right? The change in it does not really make a huge difference. So, with that kind of idea, we can use this form of currency to make projections in the future. All right. So again, we talk about so it doesn't really take into effect of inflation or any recessions, decreases, or anything like that, right? Because again, I asked you the question, what is a dollar today, and then what is it going to be tomorrow? What is it going to be in?
Dollar.
It's what is it going to be in 10 months,
Dollar.
and what is it going to be at the end of the year?
Dollar, I hope.
It's still gonna be a dollar. Okay. So what you can use this here is it is a perfect form of measurement for projections in the future. So I can say if I have $10,000 in sales this year, I can make a projection saying my goal is to make that 10,000 into 25,000, but still keep my cost the same, right? Or make those minor changes, or I could still sell my product the same price because at the end of the day, I can still make that projection saying, I have a goal next year. It's going to be a good year. I'm going to make 25,000 instead of 10,000. All right, and why? Because it's a stable form of currency. Okay, and it doesn't it doesn't acknowledge inflation at all. So this is perfect for those kind of projections. Okay. All right. Any questions there?
Yep.
All right. Last but not least, we have the accounting period once again. Now, in this case, we know the accounting period, right? The definition is that it's whenever you schedule the accounting cycle to be completed. And we have an example, right? Daily, weekly, monthly, whatever, right? The United States GAAP allows us, the reason why we have the daily, monthly, annually is because GAAP allowed us to break our accounting periods in those smaller sections for the reason of once again, to measure profitability, okay, or to measure some kind of performance in your company, right? So a great example is that if the accounting period is monthly, then you can always process or create your monthly profit and loss reports, and that right there is going to give you, right, did you make a profit this month, yes or no? Did you have too many expenses this month, yes or no? So here you can also measure your performance, right? If you do a monthly profit and loss report every single month, and you collect that over a course of a year, you can see a graph. You can create a graph, and it's going to show you: is your company increasing? Is it performing well? Is it doing bad? Is there something that's occurring that's why there's a huge dip? So that's exactly what the assumption here is, that they break down the accounting period just so then they can, or you're able to find any means to measure performance in your company. All right. Any questions there? Oh, and they tell you that it has to be a consecutive 12 months. Okay. All right. Okay, well, that's the assumptions there. Okay. Next section here is going to be basic principles. Okay, so the basic principles are going to be these four. We're going to talk about the first one, which is going to be the historical cost. All right, so what this definition is that when you are acquiring either assets or just anything in general, if you're making a huge purchase, the day that you purchase it is going to be the amount that you're going to place in your journal. Okay? And what does that even mean? So if I bought a printer for, or let's say, or I'll do the example here. I buy a machine that's worth $50,000, right? And let's say this piece of machine, right? No matter where in time, right? That's the price I purchased it for. That's my fair market value. Okay? I originally purchased it at $50,000, so it's going to stay in my book as $50,000. Even if I do like upgrades, fixtures, maintenance, and I made it performing a lot better, it's still going to be in my books as $50,000. Okay? And that's this rule here. Until you sell it. Now, the day that you sell it, right, you're still going to write it off as $50,000. But at the end of the day, you either are going to get some kind of cash out of it, and or a loss. Okay? So you can recognize a gain or a loss. Okay? So do not confuse this with property with realtor or property management, okay? Especially when you buy homes, right? If you bought a home for $100,000, right? 10 years from now, it's now worth $350,000. No, you cannot write in your books that it's worth $350,000 because that defeats the purpose of this historical cost. Again, if you've learned property management, you're going to have to, remove that section out of your brain because they do some different type of accounting, but it is definitely not the same thing. So in this case, if you are property management, you purchase a home for $100,000, then yes, in your books, you can say it's $300,000. In this accounting, no. Until you sell it, right? Let's say I do sell it, then I can recognize whatever cash I get, and I can recognize whether I gained something or I lost something, which actually tailors into the recognition, revenue recognition. Okay? Now, before I say that and continue on, there are some exceptions to this rule. Okay? So the exception is going to be inventory as well as securities. Okay? So again, if you purchase a bank security, right? Or a bank bond, it's worth $100,000. The day that you redeem it, of course it's going to. That's like the only exception that you can adjust the inventory, adjust the value for it, because you're in it. It's one of those investments that you can recognize. Inventory, and we're going to talk about this in chapter 6. What happens when we purchase inventory and it's been 10 years later? Do you think that inventory is going to be the same value?
No.
Absolutely not, right? We got better technology every single year. So you can expect that your inventory is going to drop significantly. And that's the only one where you can make an adjustment to this, because whatever you originally purchased it for is not going to hold its value when you try to sell it 10 years later. Okay? Any questions here?
Nope.
Okay. So now, next section is going to be revenue recognition. So this is actually going to also apply with the accrual type of accounting, which I'll talk about at the very end of this. But here, it tells us that when you record a revenue, you record it when it's been realized or when it has actually been earned. Okay, now what does it mean to be earned? Okay, so if you provide a service, or if you sell a product, so for example, I'm going to record a sale of an item, okay, or a service, and when I complete the service or get rid of the item that I sold, that day I'm going to recognize that I received, or that I earned, the revenue. Right? So here the initial idea is that when a service has been completed, you earn the revenue. When a product has been sold, you earn the revenue. Okay? Any confusions here? Okay, so again, this part is kind of, it will come into play when we deal with the sales section of so chapter 6, because when we deal with sales, right, even when the product has been sold, you recognize the revenue. Okay, and this is actually going to come in play, or come hand in hand with the matching principle, right? So here it says that for all expenses that are associated with generating that income, that's what you have to do. You have to match it. Okay? Now, for example, right, we talked about when you make a sale of an item, right? You also have to think about how much did it take you to purchase the item. So that's where the cost of goods come from. And also the cash that you actually earned a profit for. So those are going to be the two types of things that you're going to match with the revenue, right? You're going to make sure that your revenue is equal to your expense, or the cost of you selling that item, plus the amount of profit that you gained from it. Okay, and that's going to be matching principle. Right? Any questions there?
No.
Okay, so again, same thing with doing business, right? All right, and then last but not least is going to be adequate disclosure. So this is going to be one of, I guess, I would say important, especially if you have pertinent information that is related to your business, but you have no place to put it. So again, we have a spot where we can place all the information that we need, that is necessary, that is involving our business. So we call that the notes to the financial statements. And what that does, here's an example, is when I talked about my employees, right? If I have a total of 20 employees, in my journal, I record it as $100,000. But in this case, if I just looked at my journal only, and it says that I have my salaries and wages expense is going to be $100,000. What does that tell me?
How many employees you had?
It tells me how much it costs me to have my employees, but is there anywhere I can place the number of employees?
No, because all you're given is just a total cost. You're not given the number of employees.
Correct. And that's why we have the notes to the financial statement. So you can go ahead and enter in saying that I have 20 employees, right? Now, again, how you're specific to your financial statements is however information that you feel that's necessary to express why you have $100,000 cost in employees, right? You could say 10 of them are salary based and 10 of them are wage based. You don't need to reveal who they are, what they do, but the basic line here is that if I have 10 employees with salary based of $10,000, which is not that much, but example here, and then my wage based are 40 hours a week at $10 an hour. I can release all of that information in the notes to my financial statement. So then it kind of helps validate your transaction, but it doesn't leave you hanging either, right? If once again, in my journal it says I only have $100,000 worth of employees, this is where this transaction can back it up, or this information can back up the idea of your $100,000 cost. All right, and then of course, any questions there?
No.
Okay. Good. We're doing good so far. All right. So now we're going to talk about modifying constraints and or conventions, whichever one you want to use. Okay, they both mean the same thing: constraints, conventions, whatever. Here I have the first one, which is my materiality convention. Okay, so in this one, this is kind of confusing, and it really depends on how you look at it. But the definition of it is that, is this transaction significant enough that it truly affects your business? And if it doesn't, then don't record it. All right, so when we talk about materiality, right, there's a lot of things in the world that have some kind of value to it, but how do we put a price on it? That's the question. So in this case, right, I'll give you a perfect example that makes it simple and easy to understand. So if I am in charge of my assets and I make a purchase of an asset, right, I buy myself a $5 trash bin. Now, in my books, if I'm a $1 billion kind of company, right, and I'm making thousands of transactions a day with thousands of dollars, is my petty little $5 trash can going to make a difference?
No.
No, it's not. It's not. So you can choose to record it or not. You can just use it as a business expense as well, right? It's not something that you want to. It's not like a $50,000 machine. If you have a $50,000 machine, that's a huge effect in your company, right? But for this is a simple $5 trash can. Is it worth it to record? Okay, and in fact, I could probably just buy it as a personal expense and just take it home at the end of the day, right? So that is materiality. Is it worth enough or significant enough for you to record? Okay. Any questions?
Nope.
All right. So the next section here is going to be my cost benefit convention. So this one, the definition is the benefit of providing the financial statements. Is it going to outweigh the cost it takes to produce it? All right. In this case, I'm going to explain it a little better. So for example, right, if you have two alternatives, Okay, so let's say you're a t-shirt company. You have an alternative, number one, to either produce the shirts here in the United States, and the benefit is that you can get those shirts in 24 hours and you can sell them right away. However, a bad thing is that it's going to be super expensive. Okay, it's going to cost a lot. Whereas you have option number two is that you that you decide that you could either outsource it to another country. They can produce the shirts for you. However, the only bad thing is that it takes a week to ship it back to you. You know, international trade. It takes a week to get back to you. However, the cost is low. It's super cheap. So, those are the two alternatives, right? You have to weigh the benefits and the cost that apply to it. So the same thing here. Is it worth it to supply my financial statements? But I'm going to weigh it out to the cost it took me to provide that, that financial statement. So in this case, that's the cost-benefit convention assumption or conventions. Okay. Any questions there?
I don't think so.
Okay. Now again, cost, benefit, and the conservatism is going to be, they kind of go hand in hand, right? The definition for this one is that out of the alternative options that you have, you would most likely choose the option that will least likely to overstate your assets. Meaning, if I look at these two options, right? My option is I want to make sure that I keep my assets as low as possible and keep my costs as low as possible as well, but make sure that it's, I don't, the purpose here is that I don't overstate my assets. So in this case, I would choose the option that allows me to lower my assets or lower the price for my assets. So a good example here is that you can practice this. So for example, when we go into purchasing inventory, we're going to be looking at how to cost something, right, when we sell it. And of course, when we do that, there's always going to be that fundamental thing where you're going to have a tenth of a penny, a millionth of a penny, a thousandth of a penny. And in reality, can you sell a thousandth of a penny, or can you cost a thousandth of a penny?
Are we talking stock market or just material wise?
Just
or like gas?
Just in this kind of concept, it's just here. Like in the United States, right? Can I charge you a tenth of a penny?
Yes, because our taxes is set up the same way.
Okay, if so, you're gonna give me a penny and you're gonna break it into 10 pieces.
Well, all right. What is our tax rate? Like 8.25.7.
Correct.
So, yeah.
That is where this is going to come into play, right? We have we have to round it to the nearest penny, because I'm not going to go to the gas station and you say, oh, I'm going to charge you this much percent tax, so your total comes out to be $10.85 and a tenth of a penny. I'm not going to sit there and break a penny in 10 parts. I'm going to round it, and that's what we're doing here. However, of course, for tax, it's straightforward. The government wants their money. They're going to always round up no matter what it is. But in our side, when we do our costing for our business, if we choose to be conservative, instead of right here, this example here, we have 1.855, you have half a penny. We're going to choose to round down because we choose to be conservative, and instead of charging or costing my amounts at $1.86, I'm gonna round it down to $1.85. Okay, That's the conservatism right here, is that I don't want anything to overstate my assets. So instead of rounding up, I'm going to take that and just take that as a loss or a cost of doing business, and be conservative and just take the lower amount. That's the idea here.
I
Okay.
used to do that with inventory.
Yes, inventory, right? Because if you follow this guideline, you never round up for any reason unless it's like higher than a 5. But if you get that 5 where it's half in the middle, you're gonna have to round it lower. Okay, that's just the conservatism uh, part of this constraint. Right? Any questions there?
Nope.
Okay. And then last but not least, we have industry practices. Industry practices is it's in a sense what we do for industry practices. It is customary that if someone in the same what do you call it, same industry. So for I gave that example, right? Let's say I'm Starbucks. The people that are in my industry are going to be Dietrich's Coffee, Dutch Brothers Coffee, Dunkin' Donuts Coffee, right? Because they all generally sell a product, but more specifically, they sell coffee. Okay? Now, with this constraint or this convention, is that the idea is that if I'm going to be producing my financial statements, right? I want to kind of also take a look at their financial statements and kind of follow them in a sense where what are they doing right? What can I do to make my financial statements look exactly like theirs? Okay? Now I don't mean go call them and tell them what their secret is. I literally mean like, look at how are they doing this. Are they spending more money on more advertising? How do their financial statements look? If I make mine look similar but identical to their, their spreadsheets or whatever, their financial statements, will it help me benefit myself? So that's what the idea here is, that if you own a coffee shop, which I just told you about, you generally would follow in the same kind of direction as those companies that are in your same type of industry. So if a new rule comes out and they're on that rule and they're producing their financial statements based off of that rule, you're more likely to gear towards that same exact methodology. Okay? So that's what an industry practice is. Any questions there?
No.
Okay. Now, for this class, I will only test you on the first 8 things that we learned on, because this one is for technically more for business management, right? Determining if this is significant enough to record, right? That's definitely, I mean, that's kind of going towards what we're doing, but in this case, the transactions are going to be straightforward. Whereas making alternatives, that's going to be that's not your job to do. You're not going to be setting up those alternatives. Someone else is going to be doing that. That's more for management. Who's going to make that executive decision? The management. And then lastly, why do you need to go look at yourself with someone else's that's in the same industry? That's definitely going to be management. Okay? So all of this is not going to be on the exam. Okay? So you're only subject to know the accounting assumptions and the principles. So just those 8, because the principles are 100% what you're going to be doing. You're going to be journalizing everything at historical cost. You're going to recognize your revenues, and you're going to cost them against your revenues and make sure that they match. And then the financial statement part, or the notes to the financial statements, we talk about it, but we won't do it. Okay? So any questions there?
You're talking about the steps of the accounting cycle?
No. I'm talking about the gap. Okay? I'll go over it once again at the end. Okay?
Okay.
So, so constraints and conventions are not going to be on the exam because they're definitely not something that we're going to be focusing on when we do our daily transactions. Okay? So, any questions there? So, I'm going to go over this cash versus accrual real quick. Then we'll go on a break, and then when we come back from a break, we'll go ahead and do the exercises. So here we are, cash versus accrual basis. So we touched bases on this very briefly in chapters 1, and I think again in chapter 3. So how the cash basis versus the accrual basis works is that here, the difference between the two is if you are a cash basis, you're only going to recognize revenues when cash is received. And you're only going to recognize expenses when cash leaves your hand, or in this case, when it's actually available to spend. Okay? So once again, if I sell an item, right, that's considered a revenue. The day that I receive the cash is going to be the day I recognize that revenue. Okay? Same thing here. If a job has been completed, right, the day that I pay is going to be when I actually recognize that expense. Okay? Whereas the accrual basis, which most businesses are right now, like all corporations must follow the accrual basis. So here, this is going to be different. This is where transactions that deal with revenues, right? You recognize them the day that it has been earned. Okay? And then any expenses are going to be recognized the day that it has been incurred, which means the day that it was completed. So in this case, I'm going to record my revenues the minute my service has been completed or when my product has been sold, because I've earned it. All right? Expenses, the day that I receive a bill is the day I'm going to recognize it, or the day that it's been completed, I'm going to record it. Now these ones, it does not matter whether you receive cash or not. Okay? Because we have the idea where we can owe money, right? We can have, if you record a revenue, regardless if you got a payment of cash or not, you can always record it as an accounts receivable. People owe you money, but you never receive the cash. Same thing with an expense. If you received a bill and the job has been complete, the job was completed regardless whether you paid the bill or not. Okay, so we use that as accounts payable, right? We owe people money. Okay, so now I'm going to go ahead and go through an example with you. All right. So here we're taking a look at a construction worker, right? So you're a construction worker, right? And your task is to build an office building for $50,000. Okay? Now, the construction starts as of January 1st and is scheduled to be completed by April 30th. If the company pays you $50,000 on January 1st, how are you going to record this transaction? So we're going to talk about the service, right? If I get paid as of January on the cash side, when am I going to record that the service has been done? Okay, when am I going to recognize this revenue? Okay, so under the cash basis, we're going to do cash basis first. When am I going to journalize as of January?
On January 1st,
What am I going to record?
the 50,000.
Yeah, that I received $50,000. Okay? And then when April comes around, I've already received the money. So in this case, regardless whether the project was done, I received the money. So in this case, in April, I don't record anything. Okay? Now let's talk about an accrual basis. The job is not scheduled to be completed until April. So what are you going to record in January?
No cash.
You record nothing. But in April, because the job has been completed, that's where you're going to record the $50,000, regardless whether you received the cash or not, right? Because you can always bill them. Okay, so does this make sense?
Mm-hmm.
Okay.
Yes.
All right, I'm going to do another example here. Okay. So let's say, so same idea, right? You're still the construction worker. However, the only difference here is that even though the construction project is supposed to start as of January 1st and it's scheduled to be completed as of April 30th, if the company decides to pay you the $50,000 at the end of the project on April 30th, how are you going to record the transaction here? So let's look at the cash basis. What am I going to record in January?
0.
0, because why? We never received the cash. So then what's going to happen in April?
He pays you the 50,000.
We're going to recognize that he paid me the money. Okay? What about on an accrual basis? If the job has been completed is as of April, what am I going to Yes.
He paid already in January.
It would, yes. And the job, the initial idea of what the accrual basis is, you have one criteria. Was the job completed or not? In this case, it was completed in April. So there you go. You don't need a journal entry in January because you're going to recognize that the job was done as of April for $50,000. Okay? So that's the difference between a cash basis versus an accrual basis. The difference is that as long as you're receiving the money, that is when you're going to record everything. So that's on a cash basis. The accrual basis is as long as the job has either been completed or the product has been sold, that is when you're going to record everything. Okay? Any questions there? Okay. So again, chapter review. So again, here is the 10 steps to the accounting cycle. Once again, you do need to know the sequence of this and that how it flows together. However, in this class, we will only practice the first 3, okay, until we dive into the class project. That's where we're going to take a look at steps 4 through 10. So in class, we will complete all 10, but for this test, you need to make sure that you know at least the idea and what order they belong to, because they have to go in a specific order. You have to journalize first in order for you to fill out your general ledger, right? How can you have an account balance if you don't have the daily transaction happen first? Same thing with the trial balance. You need to have the list of all the balances in order to create the trial balance. Okay, so that's the 10 steps there. Other things here, just a little FYI. I want you to know what accounting period is. So again, it's when you schedule the accounting cycle to be completed. And here are the examples here. It could be any of these, you could complete it within those different ways. And then make sure that you understand the difference between calendar and fiscal year. You need to know the 4 characteristics of a financial statement. And then, of course, here we're going to talk about the generally accepted accounting principles. So once again, I don't have the definitions here, but I have the list of what they are. And you're responsible to know what they are, because I will test you on what they are and how do you apply it in a scenario. Okay, so take a look at those examples and try to make sense of it. Okay, now remember, I'm only going to test you on the assumptions and the basic principles. I'm not going to test you on the constraints or the conventions, whatever you want to call them. So you only need to know the first 8 out of 12. Okay?
I'm sorry, you said you're going to test us on the consumptions and what else?
The assumptions and the principles. Now, here's a fun fact that you could learn how to do this. I haven't figured out what the other mnemonic device I could say for this, but a good way to say is we're learning the generally accepted accounting principles, right? It's just like learning your ABCs, right? You got your assumptions, your basic principles, and you have your constraints. ABC, right there, okay? I'm only going to test you on A and B. However, for general purposes, you should know all ABC, okay? All right. And then lastly, we talked about the cash versus the accrual. Cash is you only record revenues and expenses when cash is either received or available to spend. And then lastly, accrual basis is you recognize the revenue or expense when it is either earned, so when it's been completed, or when the product has been sold. And then you record the expense when it has incurred, when the day that the expense happened. Okay? And then regardless of whether you received cash or not. Right? Okay? Any questions in regards to chapter 4? All right, it is exactly 3:30. We went a little over time, but go ahead and take a 20-minute break. So please be back by I'll give you an extra minute, so no later than 3:41.